Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hi, everyone. Welcome back to the DIY Wealth Canada podcast. I'm Nelson. I'm here with Bob, as always. Today, we have a very special edition of the pod. We're going to go through your reader questions. A few weeks ago on my newsletter, I did a Ask Nelson Anything edition, and we ended up with a bunch of questions that I wasn't able to use. So I'm doing the rest of these on the pod, and then we get to hear Bob's opinion on these as well. And Bob, there's one particular question that we're going to save to the end because we think it's funny, but why don't we start with Telus? Telus shares are struggling as we recorded this. I think they're right at around a 5-year low. I think they're about $19 each. So not doing super well. So the question is, and this came from, sorry, we won't say any names of who these came from to keep things anonymous. But the question was essentially, should I sell my Telus shares or should I continue to hold? Bob, what do you think?
Yeah, I definitely get a lot of questions about Telus. I guess last year was about Bell. So if you look at the telecommunication sector as a whole, both the Canadian and the US telecommunication companies have been struggling, right? So Telus, Bell, Rogers, AT&T, Verizon, and probably a lot of listeners remember that Bell cut its dividend payout, I think by 50-something% earlier this year. And that was, for the most part, everybody anticipated it because the yield was too high. The debt was way too high. And Bell has done some kind of silly things, in my opinion, in their assets. But in terms of Telus, yeah, it's the share price has been struggling for sure. It just keeps going down and down. And I think one of the investment firms actually downgraded the Telus stock a few weeks ago, and the yield is now, I think, it's north of 8%, almost 9%, which is extremely high, right? So if you look at the payout ratio, it's definitely over 100%. So the question is, should you sell Telus shares or continue to hold? For us, we're continuing to hold because it's relatively small percentage of our overall portfolio, and I typically hate to sell. And my justification is it's already down so low. Like when you sell it at this kind of low price, you're just hurting yourself in many ways. So what we're doing is continue to hold. We're not adding more shares actively. The only way we're adding more is through DRIP, so dividend reinvestment plan, where when we receive dividends, that gets purchase additional shares. The way I see Telus on a macro level is I think the best thing for Telus to do is, one, stop raising their dividends. If you look at their dividend payout history, they've been increasing. I can't remember how many years straight, but they've been increasing in terms of percentage lower and lower each year. They should just altogether stop raising dividends and get their books in order. Two is, I think Telus, compared to Bell and Rogers, Telus is more just strictly telecommunication, where you look at Bell and Rogers, they have the media side of things, which is very complicated. So Telus is simpler in terms of its company structure. But yeah, it's still in a lot of debt, but I think if they don't increase the dividends, their free cash flow, I think, covers the dividend payout. Nelson could back me on that because I think Nelson does a little bit more research. But if they don't, I think it makes sense for Telus to cut the dividend payout by a little bit. I don't think it's as drastic as 50% that we saw with Bell, maybe like 20-25%, just so Telus could clean up its books. So that wouldn't be an unwelcome move from Telus, in my opinion. So yeah, I think for us, we'll continue to hold and see what happens. Nelson, over to you.
last year with BCE, the whole situation there was BCE embarked down this path to pay down debt, and then they sort of abandoned that path to acquire those US broadband assets, the Ziply transaction. And the market did not like the Ziply transaction for a number of reasons. We won't go down that. But the point is that Bell was going down this path to reduce debt and to potentially get its interest payments under control, which would all float out to the bottom line. That's the way that these things work. And they never really had a chance to go down that path. Now, Telus basically needs to do the same thing. The debt is too high, and they need to cut some of that debt, get that down to a more reasonable multiple, and then they can afford the dividend more easily going forward. So as it stands today, the payout ratio is about 75% of free cash flow, but that's a little bit misleading because Telus issues a lot of shares in rather than paying cash. A lot of people have decided to take their Telus shares in the form, or their Telus dividends in the form of other Telus shares, which is no cash coming out of the company's coffers. They just create the new shares, but ultimately that creates more dividend obligation, and they have to stop that. So they do plan to stop that. Anyway, Telus has assets that they can sell. They have a bunch of real estate assets. They have Telus Health, which is their telehealth kind of initiative where you can talk to your doctor over a webcam rather than in person. They've got these assets that they can sell, and they can use the proceeds to pay down debt. They've also have a transaction to monetize their part of their tower network. So essentially they've sold off, I think it was 49% of their towers to a third-party investor, and then got, I think it was about 1.2, 1.3 billion out of that transaction, which they used to pay down debt. So I think that if Telus does these things, the dividend survives intact and everybody's happy again. So would I sell my Telus shares? I have some Telus shares. I do not plan to sell them. I'm just going to hold. But unlike Bob, I'm not going to drip my dividends into new Telus shares. I'm going to take those dividends and invest them somewhere else. My favorite play in the telecom sector in Canada continues to be Quebecor. It has a better balance sheet, it has better growth potential, it is a much more affordable dividend, and it even trades at a lower valuation than Telus. So that's my choice there. Okay, Bob, what's the next question?
Let's do an easy one. So does CPP factor into your retirement plan?
Oh, good. I get to rant about CPP truthers. Okay, so first I'll answer the question and then I'll rant a little bit. Does CPP factor into my retirement plan? No. The reason is because I have taken care of my retirement to the point where I don't need CPP in order to have a comfortable retirement. It's going to be there, and it'll just be a little bit extra on, the cherry on top of the sundae, if you will. So no, I don't factor it in. Now my rant. And my rant is that there are people out there who think that CPP is somehow bankrupt or it's a Ponzi scheme or whatever, and they think that they'll never get a dime from CPP, and that could not be more ridiculous. CPP is one of the best funded pension plans on the planet. It is miles better than U.S. Social Security, which just comes out of their general government revenue. CPP is separate. It's ran by a separate organization, and your money is safe inside of there. It continues to grow. It's invested by some of the smartest people out there. It's a wonderful retirement plan that is going to be there when you retire. You will probably need to save more than just CPP, but it's one of those things that makes me happy to be Canadian, that we have one of the best retirement plans on the planet in terms of government ran retirement plans anyway. And to anyone who thinks that CPP is a Ponzi scheme, by all means, sell me your CPP income. I will buy it. I will not pay you a lot for it, but I will buy it. 100% serious offer. Not really, but I will buy it.
Yeah, for us, we don't take CPP and also OH security into our retirement plan consideration. The way we see it is that both CPP and OAS are just extra gravy. right? If we get money out of the CPP and OA security, great. We're definitely not planning those two into our retirement numbers. And I mean CPP, I can't remember how many years you have to contribute to getting max payout. But if you're looking for early retirement, chances are you won't be paying the full maximum years of CPP. So you're not going to get the maximum amount anyway. So that's just how I think. And a lot of people are freaking out about the clawback for OAS. And again, the way I see it is, oh yeah, clawback sucks. You want to kind of get as much money as you can, but if you're getting clawed back on your OAS, that means you're actually doing quite well in your retirement. So that's actually a good thing, right? If you have to rely on OAS and CPP just to get by, that's pretty tough. Now I know I do know people that have to do it that way. That's just how things work out for them, and they're fortunate they could rely on CPP and OAS. But for us, we're not counting on those two. That the money that come out from CPP and OAS would just be extra gravy for us.
Yeah, I think too, just very quickly before we move on to the next question, that in terms of OAS clawbacks and everything, my opinion is that they're likely, you're allowed to make too much money before OAS is clawed back. I think OAS should be kind of rejiggered to help out lower income Canadians, where there are Canadian couples that are making, comfortably six figures in retirement income and combined, not individually, who get OAS on top of that. They don't need it. And I would like to see some rationalization of this program, but that's a different topic for a different day, because we're going to talk about, Bob, how would you invest money needed for a down payment 12 months from now?
Oh, that's a very good question. I first of all wouldn't invest that money in the stock market because I think it's going to be too volatile over the next 12 months, right? I would probably invest in one of those like cash ETF or one of those high savings as were GIC ladders or even market money fund, just so you're getting a little bit of interest on top of your money. That way you're not really tied to how the market is performing and you could take the money out, right? So GIC ladder would be the classic way I would do it, like put a little bit of money every month or something, just so you're not locked into specific interest rates, and you could potentially get a little bit more by doing like a 1 month or 2 month GIC ladder, cadence scattered throughout 12 months kind of thing. So that's how I would do it. Nelson, what about you?
Well, I completely agree with your point of don't take unnecessary stock market risk. You never know what stocks are going to do over the short term. You might invest in the most surefire 100%. It's going to go up, and then it all goes to hell and it doesn't. So exactly right. Take that risk out of it and just focus on the very extreme safe part of the market. So that's 90% of the heavy lifting right there, is making sure you don't lose money. In terms of earning some interest, I think absolutely you should try to earn some interest, keeping in mind that you don't want to stretch and make things any more risky than what you possibly could. And there are ETFs out there that invest in things like, collateralized loan obligations, and these ETFs will tell you, oh yeah, we only invest in the best ones, and therefore, like, we're giving you a 5% yield where everything else might give you like a 2.5% yield, and oh wow, like this is safe, when in reality it's like, well, there's a reason why it pays 5%. So keep that in mind. Saying that, the number one thing that I would do in that situation is I would chase high interest savings accounts promos. So what that is a Canadian bank will say, hey, we would like to attract some capital. We are willing to pay, say, 4% over 3 months. So you open the account, you put the money in, you collect and of course, when I say 4% over 3 months, that's 4% annualized over 3 months. So you'd get a quarter of that, you get 1% over 3 months. And then you do it again and then again and then again until it's time for you to take the money out. This way of doing things is 100% guaranteed by the Canadian Deposit Insurance Corporation. It just takes a little bit of work. And in exchange for that, you can make a little bit of extra interest, which should be worthwhile if you are looking at a relatively large amount of money that you're looking for, like I'd say a house down payment. So I would do that. It's a little bit of extra work, but I think you can conceivably make, an extra few $100s doing so, which I think is worth the time of doing these promos. And if not, hey, you just stick it in a high interest savings account that pays a decent amount of interest, and you will do just fine doing that there as well.
Great. Okay. Next question. How do you guys go about researching a stock? That's a good question. For the most part, I don't do too much research on a stock anymore. I mean, go back to that episode we talked about hedging your consumption. That's kind of the way I do my research, or kind of pick the name, because right now, our investment portfolio has quite a few positions, so we're not actively researching a new stock. Now, if I were to research a new stock, typically what I do is I go on the company's investors relation website and then go through the investor presentation to understand what the company does. And I may read, the quarterly reports, like the last couple of quarters, to see what they say. And I would look at the annual report to get some key trends and any important key messages from the company. And then I would then look at the valuations. I would do some research on what's the historical P ratio, what's the historical EO, book to debt ratio, the PEG ratio, and just to see what kind of growth I'm anticipating from this company. And then I would look at the macro point of view. It's just like, what does this company produce? Is this something that people rely on? Is it difficult to switch? And so on. Right. So that's typically what I would do in terms of research. And then in terms of buying decision, I would look at, again, the historical P ratio, historical EO rate. Now, if the EO rate is higher than the historical average, then maybe that means the price is undervalued. And then, also look at things like, are there new innovations coming down, like any rumor mill on future products or future innovation, and so on. So that's how I typically do research. Nelson, what about you?
I'm going to divide it into two sort of scenarios here. So the first scenario is a company that I don't know at all. It's a relatively new investment target for me. So in that scenario, I would do kind of what you do there, Bob. Where first thing is I look at the investor presentation. I see whether it's something that I'm interested in. And at that point, I probably have eliminated at least 50% of companies where it's just like, hey, this isn't for me for whatever reason. I think it's a crummy business. I don't understand it, so on. And then at that point, then I take a look at the company's financial metrics. And I'm looking just at things like return on equity, return on invested capital, the balance sheet, and so on. Just a very quick look at some of these ratios, because I want to determine whether I'm looking at a good business or not. And just the quick and easy way to determine that is generally kind of, it depends on the sector and et cetera, but generally those kind of return on invested capital, return on equity. So then at that point, it's like, okay, so I've eliminated a bunch of companies at that point. The ones that I'm interested in, I will start with the last annual report and I'll go through that. I'll identify what I think are the main drivers of the stock, and then I'll do more research on those particular things. So, if it's struggling, and I do generally look at companies that are struggling, so I figure out why they're struggling, and then I look at what sort of potential they have to turn around those struggles. And in that point, I would say that old annual reports are your friend, because so many companies just go through the same issues every 5 years, every 10 years, whatever, and you can see how they've dealt with that issue before. So that's in terms of my, kind of if I've identified a company for the first time. If it's a company that I know and that I already own, I'm more concerned with quarterly reports because I want to see what's happened lately. And like I said, generally I'm looking at stocks that are down. So I want to see why it's down and kind of see what's going on there. And then at that point, I will refamiliarize myself with the financials. I'll look at I like analyst conference calls that they have every quarter. I like to see what they're talking about in there. So typically it's, from beginning to end, it's really only 2 to 3 hours for a company that I don't know very well. And then maybe 1 to 2 hours for a company that I'm just refamiliarizing myself with again. And then I will keep an eye on companies as quarterly earnings come out there, etc. But really it's gotten a lot less complicated as I've gotten older and that I have more experience analyzing under my belt. I feel like I know what to look for. All right, next question. Bob, how would you determine your retirement number? And how do you know that that'll be enough? Because that's a really hard question for a lot of people who want to retire early, isn't it?
Yeah, that's the tricky part. I think the simplest way is just look at how much you spend on an annual basis and then multiply that by 4. Right? So not 4, 25 divided by 4. So that's multiply 4. That doesn't make any sense. So say if you're spending $100,000 a year times 25, that means you need 2.5 million in your investment portfolio. That's your 4% withdrawal rule, right? And if you spend less, then you need less. Now that's the general rule of thumb. Now, obviously, you never know if your spending is going to stay the same, right? There's inflation, blah, blah, blah. And if you have a family, you have growing kids like us, that the number tends to increase rather than decrease, at least when the kids are young or growing up, right? But then when they're out of your home, they're on their own, your annual spending may decrease, right? So yeah, it's a very difficult number. For us, when I started the blog, we were aiming like 50 to 60K a year spending in early retirement. Now we have increased that number slightly. So right now it's probably around 60 to 70K. Would that number creep up again to 80K? Sure, that could always happen. But I think one thing you need to figure out is like, how comfortable are you with your expenses? Like, or do you think you cut back on certain things, or do you think you will continue to spend more and more? And the thing is, you never know if it's enough or not, right? So that's where that one more year syndrome is very famous, right? People they think they have enough, but they're unsure, so they decide to stay at the work for another year or 2 or 3, and then next thing you know, it's like a decade or 2. Sometimes you just need to take that leap of faith and figure out on the fly. We're definitely not quite there yet. We're really close. We're doing all we can in terms of planning and making sure we build up buffer and have some margin of safety. But the reality is you never know 100%, right? You just kind of have to decide and then figure out. But there's many different ways to build that margin of safety. So I'm sure Nelson could talk a little bit about it. But yeah, I think the easiest way of determining your retirement number is look at your annual spending and work backward from there.
Yeah, you're exactly right. It all comes down to spending and the realization that there's 2 buckets of spending. There's spending on necessities, and then there's discretionary spending. And the ability to know the difference in your budget and the ability to be able to say, okay, if things go poorly, I can always cut back on discretionary spending temporarily while I wait for dividends to be restored or whatever has happened in that scenario. I think the very easy way to kind of build in that buffer that Bob, you talked about, is instead of doing like a 4% withdrawal, which should work for just about everybody, unless there's some mistakes that have been made, aim for like a 3% withdrawal rate instead. That gives people that buffer that you can have in case that things go wrong. And two is it gives a little bit of money that you can reinvest. So if you have, say, like a 4% dividend yield from your portfolio, you spend 3%, you reinvest 1%, that allows you to keep growing the overall portfolio, which should help increase dividend income over time. And two is that I think that one of the biggest challenges that retirees have, especially early retirees, is that it's very hard to go from a save everything to spend everything mentality. And by giving yourself that buffer, you can take some of your dividends and you can reinvest them, and that helps mentally, which I think is something that does not get discussed enough when we talk about early retirement.
And just to add, you definitely that you call it necessity core expenses versus discretionary expenses, right? Like, do you have to travel internationally every year, or do you scale back a little bit, right? That's what discretionary expenses you cut back, and that could help you reach your retirement number a little bit earlier rather than later. So yeah, expenses is definitely something to look for and figure out, and it helps to know what your trends are. That's something you could track your expenses over the years and then kind of figure out a trend. Is your core expenses going up because certain reasons or so on, right? So I think knowing these trends is quite important as well.
Yeah, for sure. Let me ask you, Bob, what's a reasonable long-term return target, and what number do you use? And do you think that, like, maybe talk a little bit too about the dangers of assuming a little bit too much like we've had in the last kind of 15 years?
Yeah, so that's a very interesting question. If you look at the long term, the very, very long term historical rate of return for the stock market is, I think, 8%, anywhere between 8 to 10%, depends on which academic research you look for. So I personally think 8% is something reasonable to set target for, but that's like the average over, decades. So year over year, it's going to be quite different, right? So in 2025, the return would have been pretty high because both like all the stock market indices have performed quite well. The TSX has performed quite well. So in 2025, your performance rate of return would have been pretty high. But in some other year, you may see negative, right? Like the market performs poorly. So for you to say like, oh, you have to get 8% every single year, I think it's a very dangerous thing to do because you may end up chasing some riskier investments or assets as a result. So for us, we don't really set a specific target. It's kind of like, oh, if we beat the target, great. If not, if we beat the index, great. If not, so be it. I think rather than setting a target, and I may have talked about this in other episodes, it's more about, are you meeting your financial goals, right? Are you getting, you could say like, oh, I want a savings rate of 30%. That's something you could control. To set a target for something you can't control, meaning the stock market, is very dangerous. So I would more focus on things you could control, like your savings rate or your financial goals. Like, hey, I would like to get to $1 million portfolio value or $2 million portfolio value or whatever, or 50,000 in dividends or something like that. That's something you could control rather than worry about something you can't control. So we don't really, like, at the beginning of each year, we don't really do like, oh, this year we're going to do 10% in return. Sorry, we don't do that. So that's what we do anyways. Nelson?
Yeah, I think I agree with you that it's very, very dangerous to set these return goals in terms of like a year, because you're right, the stock market does not care what your goal is. It will do what it's going to do. And if your goal is too aggressive, then I think that you may make decisions that are perhaps suboptimal in terms of long-term returns. So if you say, hey, I need 15% a year, you may take much higher risk than is needed to get that 15%. You might concentrate in a certain stock that you think is a no-brainer or whatever. And it's just, those are the things that have the potential to turn out very badly. But in terms of my target, I do target about 10% per year in long-term growth. All my projections are based on 8% long-term growth because I want to be a little bit conservative, but I think that my portfolio should grow by approximately 10% per year. It won't grow 10% every year, but I think it can do that over time. Now, when I make an investment decision, when I look to buy a stock, one of the questions I ask myself is, can this hit my hurdle rate? My hurdle rate is 10%. So I look at a company like that where it's like, okay, what does this company have to do in terms of earnings growth, in terms of the dividends it pays me, and put those things together and then try to see if I think that it can hit or exceed 10% over the long term. And if it doesn't, then that's something that I don't invest in.
Awesome. So let's move on to the next question. The question is, consumer staple stocks in the US are extremely beaten down. Do you guys have any that you're looking at in this particular sector? So I'll answer that first. We do own a few consumer staple stocks in the US. I think we have, I'm trying to think here, McDonald's. We used to own Procter and Gamble. We got rid of it. We own Walmart. We own a few others. Coca-Cola, I guess. We used to own Pepsi, but we got rid of Pepsi as well. Yeah, generally speaking, the consumer staple sector has been beaten down. We have been just kind of keeping it steady. As I mentioned, we got out of Pepsi because it's kind of similar to Coca-Cola, so we decided to focus on just one because we have too many individual stocks in our dividend portfolio, right? We own Costco as well. Costco is doing quite well earlier in 2025, and then it's beaten down a little bit. If you look at the P ratio, I think it's over 50, so people believe is horrendously overvalued. But I think consumer staples are called consumer staples because they're generally speaking quite stable. They're beaten down a little bit mostly because the tariffs and also just the people are kind of betting on the high tech stock more. So these consumer staples are kind of ignored a little bit. But I think it makes sense to have some in your investment portfolio. Whatever the allocation you decide, that's up to you. But we're kind of aiming for a somewhat small percentage of our portfolio. And are there names out there? Like I said, we are not actively looking to add more positions. We're kind of looking to trim. So we're not looking at adding any new ones. But I think if you look at the long term, right, like Costco, Walmart should continue to do pretty well. Coca-Cola is kind of stable, I think. So I think they should be fine over the long term. Nelson, what are your thoughts on consumer staple stocks in the US?
I think it's a extremely attractive place to look right now. I've spent a lot of time in the past few months looking at various companies in the sector. There's a bunch of interesting names in the CPG, consumer product goods, which is basically the big food companies. I think that's the biggest opportunity there. I'll mention two names specifically. One is Hormel. Hormel's the processed meat giant that is suffering from basically the input cost on almost every kind of meat, whether it's pork, beef, chicken, turkey. They're all much higher than normal, and that's hurting Hormel. I think that those input cost pressures eventually go away, And when it does, Hormel will be a attractive investment at that point. Plus, it offers a 10-year low PE ratio and a 10-year high dividend yield, which are two things that I think are very attractive with that one. So Hormel's very quickly. The other one is, it's not really US, but it trades in the US, so we'll call it that, which is Coca-Cola FEMSA. That is the exclusive Coca-Cola bottler for the southern half of Mexico, for Colombia, for parts of Brazil, parts of Argentina, and various other countries in Latin America. The exclusive Coca-Cola bottler is a good business to be in, especially in Latin America, where Coca-Cola is dominant compared to Pepsi. It pays a very attractive dividend. I think the yield is in excess of 4%. And the region actually has growth as more people become wealthier and they can afford more Coca-Cola products. So those are two that I've bought fairly recently, and I will probably continue to add between now when we've recorded this and in the future when we release this. Bob, how many more questions do we have time for? One, and then we're going to get to our big fun finale question.
Yeah, let's answer one more and then go to the fun question.
All right, I'm going to talk about retirement abroad. Basically, a lot of Canadians struggle in order to afford their retirement in Canada. Things are expensive, et cetera, et cetera. Do you think that retiring abroad is a realistic solution for a lot of Canadians?
Did you want me to answer that first? Or
Yeah.
do you want to answer that?
Yeah, you go ahead.
Yeah, so I don't know. I think there's two sides of this question. You know, you see snowbirds that kind of spend half of their time in the US or before the whole US stuff happening, right? And then half the time in Canada. Some people decide to retire completely abroad, right? They may move to Southeast Asia where the cost of living is a lot lower than Canada. The thing with retiring abroad, and we certainly have looked into that somewhat, I would say a little bit. We did quite a bit of research, but it comes to the realization it's quite complicated when it comes to taxes. Because if you're retiring abroad, it depends on whether you give out your Canadian citizenship or not, right? So if you don't, then you could still have investments in your Canadian broker and you get taxed normal rate and et cetera, et cetera. If you give out your Canadian citizenship, then you kind of have to find ways to move your investment outside the country, because if you continue to hold, Canadian dividend stocks, or so what, you're in tax a lot higher than if you reside in Canada. So it's a complicated question. Is Canada perfect? No. Is other country perfect? No. There's always positive and negatives about living in certain countries. So you kind of have to figure out what makes sense, right? Is it about, moving to another province in Canada or a smaller town in Canada versus living in one of the major cities, or something else? Or is it about, you could do these medical trips per se if you're not getting the medical treatments you could get in Canada. So there are many different ways to do things, but in general, I think retiring abroad is quite complicated, and I don't know. I think it's going to be very difficult to do for most Canadians. It's doable, but that's not something we're actively looking into right now. Nelson?
I agree with you that it is way more complicated than what people talk about. And I think you talked about the taxes and everything. And of course, that's a very valid point. I'm going to keep things a little bit more simple. And I'm going to say that I think a lot of people haven't really considered the consequences of, say, leaving behind your family and your friends to live 5,000 miles away. That is a big, big step. And the piece of, that step is just, it's massive. And it's really hard for, I think, a lot of people to really understand what that's like until they actually do it. So there's that. There's, if you're living in Mexico, you can't necessarily go to your grandkids' birthday party. So there's all these things you have to consider. And I think that overall, that makes retiring abroad a poor choice for a lot of people. So my recommendation would be, if you are curious about that, then maybe do winters abroad. You avoid the worst of the Canadian winter. You can, if you keep your trips under 3 months, you can usually get by in whatever country without a visa. And it's maybe a little bit more expensive to do short-term rentals, but you get all those other advantages as well. So that's what I would say, is that a hybrid where you spend most of the year in Canada and then part of the year somewhere warmer is maybe something that makes sense.
Yeah, I think that makes sense as well. Okay, let's try to squeeze one more, because since we're called the DIY Wealth Canada podcast, I want to kind of talk about this question. So the question is, what's one piece of advice you would give to someone just starting to invest? So Nelson, you could start.
Sure. I'll try to go really quick here because I know we're short on time. I would say that I would divide this into two kind of people. It's like, the first question is, are you interested enough in investing to commit to learning about individual companies and whatever? Is that something that really excites you? And for me, it always was. I love learning about companies. I love kind of like the whole thing. So for me, it made sense to go down that path. So saying that, like, okay, so for someone just starting to invest, that's the first thing that they have to think about is, are they willing to put in the work to become a active investor? And if not, then it's very simple. Just keep it simple. Put a certain amount of your savings into a broad index fund, XEQT, something like that, and just invest that way. So I think the one piece of advice is that if you're not interested in finance, keep it stupid simple and just invest that way. That's probably the one thing I would say. You?
Yeah, so on top of that's a great advice. On top of that would be, ignore the news, ignore the volatility. A market is going to do what market wants to do, but focus on the long term. So, invest regularly. Don't worry too much about the day-to-day fluctuation of your portfolio value or your investment. Track the long-term performance. So, just regularly invest, buy new shares or stocks, and then let the compound work its way over the long term. So that would be my advice.
Wonderful. And then now I get to ask the question that we've been teasing about all episode. And we're kind of like making fun of this, but this is, I think, the most common question that I get every now and again, when I do these AMAs or whatever. It really is. And so I'll just ask it. Bob, what is your portfolio value? And please go down to the penny.
Yeah, I get that question all the time. Like, people are just like, why are you not sharing your portfolio value? Like, what are you trying to hide? You must be fake, all that sort of stuff. And the reality is, my name's out there on the internet. My face is out there. People know me. People at work know I have a blog and this podcast. And in fact, actually, running people around in town that recognize me and say, oh, hey, it's your Bob from Alcan. So, privacy is a very important thing. So that's why we don't post the exact portfolio value. Having said that, I mean, guys, do a little bit of math, right? Like, it's not difficult to figure out the range. So, if you look at our dividend portfolio, and I mean, I share the individual holdings that we have, and also the ETFs, you could kind of guess a range, right? So you could use 3%, between 3% to 4% yield, and then say we will receive $60,000 of dividend in a year. Divided by 3, divided by 4, that kind of gives you a ballpark, right? So it's not a difficult thing to figure out. Like, we don't own any of those called a trash high yield ETFs. We talked about that a while ago, those yield max, cough. So our dividend yield of our portfolio is pretty reasonable, right? Between 3 to 4%, sorry. So you could figure out the range. So I'm not going to share it down to the penny, but yeah, do your math and you can figure out.
Not only that, and yes, I'm not going to share my net worth to the penny either, because this is not it's just financial voyeurism. Like, knowing what Bob's net worth is, it doesn't matter to anyone except Bob, because you don't know anything to do with his financial situation. As much as he like discloses on his blog and here on the podcast, you don't know what Bob spends. You don't know what his children eat. Like, there's all these factors that just don't matter to anyone except for Bob. And so I understand the whole, like, okay, well, if I know kind of what the amount is, then I can sort of live my life based on that, and it becomes sort of this piece of confirmation. But like, look, it's everyone's situation is different, and because of that, it doesn't mean anything to know what somebody's value is. So just don't worry about that at all. It doesn't matter what your friend's net worth is or anything. All that matters is your situation.
Now, I do want to add, like, having said that, if you see somebody sharing, like, I certainly see this on Twitter or X, that somebody say they're making 70,000 in dividend or receiving 70,000 in dividend, but their portfolios only say, I don't know, I'm exaggerating here, like 300,000 in portfolio value. That should raise some concern, right? Because that means this particular person investing a lot of high yield, very risky stuff. Now, does that make sense for you to follow their advice? Personally, I wouldn't, but some people do. I think it's important to know, like, to be a little bit more conservative and know what kind of stuff these individuals are holding, right? So, we share what we own in our portfolio publicly on my blog, but yeah, there are certain things I decided not to share when I started my blog over a decade ago. One is the portfolio value, and two is our net worth. So I will stay true to that rule and not deviate from that.
There we go. Sorry, guys, I could not get Bob to disclose it to the penny. All right, that does it for this week. I enjoyed this episode, Bob. I think maybe we'll have to do another one of these again soon. I like that we were able to just lightly touch on things rather than having to do a whole episode on something.
Yeah, I think we should run this again.
Yeah, good. Okay, everyone, thanks for listening. We always appreciate it. Please leave us a comment, give us a thumbs up, etc., etc. We always appreciate it, and we appreciate everyone listening. Thanks, and we'll see you next time.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.